This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk, and financial solutions.
Yeah. Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Michael Goldberg, welcome back to Talk Your Book. You've become a crowd favourite, so I really appreciate you coming back on the show.
No, Chris, it's my pleasure. Thanks for having me back on.
Now, talk us through last year's performance. I like to open up opportunity for a humble brag for fund managers that have outperformed. So here's your chance. 2020 was a huge year. Maybe talk us through how your fund went.
Yeah, look, thank goodness it was an amazing year for us financially. We've often said from uncertainty comes opportunity, and there was certainly plenty of uncertainty in 2020. And when the dust all cleared, we returned a net return of around about 35% to our investors. So I've received many happier calls from investors and several top-ups, but I suppose that's in the past now. And the question isn't what we did in 2020, it's what are we going to do in 2021? So hopefully I haven't set the expectations too high for myself, but we've got a lot of positions that we're very excited about for the next year or two.
And with that in mind, what stock do you want to talk about today?
I thought we'd talk about a little company that we bought near the depths of the COVID crash, a little engineering company called Decmil. Have you heard of it?
I took a little bit of 5-cent placement in Decmil. I didn't hold on to it, so I've heard of it, and it's really a turnaround story, isn't it? So maybe talk us through some of the contractual challenges they had leading up to that time and leading up to a CEO change, and then we'll get into the blue sky of it.
Okay, no dramas. So I think starting off, it's worth just giving a bit of an outline of what the company actually is. So basically, they're a civil and building construction company. They got four main areas where they focus. You've got construction, you've got infrastructure, you've got energy, and you've got resources. So think about the sorts of things like detention centers in construction. Think about infrastructure building like roads and rail and bridges. In energy, they've got a number of wind farms and solar farms. And in resources, obviously, they help with mine construction and process planting and all that sort of stuff. So they've got a good mix of different clients. Very, very blue chip client base, actually. You think about the federal government, you think about the state government, obviously for the roads and the rails. And then, of course, on the other sorts of things, they've got, blue chip names like BHP, Rio Tinto, and Fortescue. So a really, really solid book of A-class customers. They were founded in about the 1970s. So they've been going for coming up to 50 odd years by a family out of Karratha in WA. That family name was Criddle. And until June this past year, they were actually involved on a board level. The company also has the highest accreditation you can get for government infrastructure programs. So it means that they're pre-approved when it comes to any bid that they're making on a bridge and a road, which gives them obviously a fantastic competitive advantage. And they tend to only bid on projects where they think they'll be one of two or three going for it. So they're looking for those high quality they're looking for those high quality projects where they can provide their competitive advantage and their special IP, and they don't really compete against those more popular, bigger projects. So you tend to find them bidding in the sweet spot of under $250 million for a project, and that really sets them up well for focusing on their margins, which I think we'll talk about later. Margins being a key focus for them at the moment. They're a wonderful business. As I said, they've been going for about 50 years. They did have a couple of wrong turns in 2018 and 2019, and that saw them in some trouble. Specifically, they saw a bit of a change in their focus. They'd gone from being a business that had really focused on profitability back in the past to a business that was looking to grow almost at any cost. So it was revenue over profitability, and that doesn't tend to be a sustainable approach long term. I think Warren Buffett calls it the institutional imperative. You find a lot of companies out there that they're doing two things. Number one, they're growing because they want to feel like they have a bigger business, and number two, they feel like the competitors are all doing it, so they feel if they don't do it, they're going to be left behind. So those sorts of decision making. A little bit of a decentralization in terms of decisions around capital allocation. So a lot of deals getting done that wouldn't have otherwise got done had it been centralized. And you saw bad deals, you saw lower margins, and you saw, what I call leaky contracts, contracts that ultimately got them into trouble. And as you pointed out, when they did that capital raising back in April or May, they really came to the market with their hat in hand. Before that, they were trading at 20 cents. They were doing the cap raising at 5 cents because they really found themselves in trouble. So, our view was essential at the time. If they don't get the capital raise away, that they're in trouble. But if they do get the capital raise away, they've actually got some clear space in front of them. And we thought, you know what, if they can do the capital raising, we're interested in being a part of it. So, you know, they raised that capital, they got their book in order, but they did come to market and sort of in airing their closets and showing the skeletons that were in there. They called out really three main projects that were the troublemakers, the trouble kids, as you were. They had one with BHP out in New South Wales, which has since been resolved. They didn't disclose the settlement terms, but from my conversation with management post that settlement, they seem pretty happy with the outcome. They've got another contest with a company called Sunraysia. That's a solar farm. I believe it's also out of New South Wales, although don't quote me on that. Started the process of the conflict by going to the industry arbiter, and the industry arbiter actually declared in favour of Decmil, and Decmil is confident that ultimately they will actually get some money out of this project, and they don't see it as a real risk. But Sunraysia has the right to take it to court, and they're going to progress through court. It's not surprising. It's a major project for Sunraysia, and so they're looking to get the best deal that they can. And then the third one they called out was a little bit different. It was a detention centre out in New Zealand. So apparently the relationship they had was with a particular manager in the New Zealand Department of Corrections. And I think somewhere along the way, that particular manager was moved on and somebody else came in. And my understanding is that it got a little bit heated, a little bit conflict, and there was a bit of a falling out between the people. And, you know, obviously whenever you're in a relationship with somebody, and anytime you're going into a project, someone, you're essentially in a relationship with them. If it falls apart, if the relationship falls apart, it's likely going to have an impact on the project as well. So unfortunately, that project fell over. It led to Decmil closing their New Zealand business just to cordon off any risk over there. Decmil actually believe that they're entitled to about $60 million worth of payments still to come. But on the downside, they also recognize that if everything were to go against them, they could be on the hook for as much as $11 million. So look, that's a project that's on the sidelines. That was something that was clearly disclosed when they did the capital raising. And look, time will tell if it works out or not. But from everything that I can understand, it seems like I don't think there's much of a liability there. And I think there might be some risk to the upside.
So it sounds like those projects have been quarantined, if you like, and they've also got rid of a lot of staff. Has the cleanup operations pretty much been done now by the incoming CEO?
Yeah, I mean, look, they'll still have some legacy projects that were brought in by previous management, but they're being managed properly, and they've had those tough conversations as you would expect, and they've really set up these fabulous processes now to make sure that A, they don't get the job in the first place, and B, they're bidding on the right kinds of projects. You know, as a company, you look at it, it's got good bones, it's got excellent people, and they've got some fantastic IP that, you know, it's almost unreplaceable. You know, management have expressed that they've resolved to focus on profitability over revenue, which is fantastic. That's what you want to see. And, you know, sure, it might mean that in the short term, you're going to see a bit of reduction in jobs won. That's to be expected as they get their house in order. But, you know, when they do ramp up, we're going to be talking about much better projects with much better margins and, you know, much lower risks. So, you know, that really is the sort of approach we want to see from a quality management team.
And one of the things you touched on already was it feels like that the macro environment for a company like Decmil is highly favourable at the minute. We've got a government, both at a national level and state government as well, looking to spend money on infrastructure projects and you know, create fiscal stimulus to make up for some of the drop in demand that's COVID caused. That linked to a strengthening resources market, you must feel like the macro environment's pretty strong for Decmil at the minute.
Yeah, look, Decmil have exposure to again, federal government and local governments as well as the resource space. I think last year about half of their earnings came from infrastructure build and about half of it came from energy, which I imagine is not that different to resources. So yeah, there's no question that the mountain of money we're about to see coming in to stimulate the country is going to have a meaningful impact. The federal government have already promised something like $100 billion over the next 10 years. And the state governments have done even more. They've said we're looking at something like 250 or almost $250 billion. That's billion with the B over the next 4 years. That's a mountain of money. That's a tremendous amount of money. Now, not all of it is going to be projects that suit Decmil. You know, like I said before, Decmil aren't looking to take those massive projects and take that big risk on their books. They're looking at the sub 250. They've got a couple of projects over 250, but sub 250 is really their sweet spot. So, you know, you look at where their margins are best. You look at where the opportunities have been for them in the last few years. And we're really talking about focusing on Western Australia, Victoria and Queensland. Now, obviously, if deals come in New South Wales or South Australia or the Northern Territory, they'll have a look at them. But traditionally, at least, they've seen most of the value in those three states. And between those three states, we're talking about stimulus of about $130 billion over the next 5 years. So look, I don't know if Decmil are going to actively target those new stimulus programs. I can't think why they wouldn't, but I don't know if they're actually going to win them. But the whole environment changes. If you're pouring in bucket loads of demand and you've got a finite amount of supply and IP, well then the cost for access to that IP is obviously going to be going upwards, which will be beneficial for any company, whether they're participating specifically in these new projects or whether they're just exposed to the general market. So look, no doubt DEC will have a lot coming down the pipeline. I think the pipeline is something like $7 to $8 billion. But if they can add on top of that, perhaps better margins or even more jobs off the back of the stimulus that we're about to see, they could have exceptional earnings 22, 23, 24. It's quite exciting, actually.
And talk me through some of the numbers. Talk me through their market cap, what their earnings are forecast to be this year, and maybe some of the potential growth you could see happening in the next year or two.
I think it's worth keeping in mind with this sort of a company that it takes some time for projects to ramp up. So, even if you're engaging in the tender process in 2021, you might not actually see any work from it until 2022, 2023 and further out. So to my mind, at least, given that they're reorganizing their house and getting their books in order, it's not really a full year 2021 story. It's more like a 2022 story. In terms of market cap, they're sitting around about the $70 to $75 million market cap. So not a big company. But like I said, they found themselves shrinking to greatness, which I have no problem with. I think expectations, both for myself and from some broker reports that I've read recently, is for cash earnings in 2022 to be around about the $18 to $20 million mark. 2023, we're probably looking at that getting to as high as $30 to $35 million. So when you look at when you look at the market cap and you account for their assets for sale, they've got a big village that they own and operate out of Queensland that they have conservatively valued at about $50 million. Well,
and that's been linked to the quarantine, potentially could be used to quarantine people. Is that right?
Yeah, it was brought up. It was brought up a long time ago. It's in the middle of nowhere, Queensland. It's near mine sites, and traditionally it's been used as a village for mine workers. They would live there when they're on site, and then they'd go home and and the cycle continues. And they did flag the idea. The federal government approached them early on, suggesting that perhaps they could use that village as a national quarantine centre. It didn't go ahead. It would have been wonderful for the business and their earnings. It unfortunately didn't go ahead. I suspect they decided instead to do regional quarantine. So if you're headed to Victoria, you get to stay in Victoria. If you're headed to New South Wales, you get to stay in New South Wales.
Yeah.
I'm not privy to the details of what went down and what didn't go down there, but it didn't get signed, unfortunately.
Yeah.
But that was what, they had that on their books at about $80 million pre the capital raising. As part of the capital raising, they reduced it down to $50 million. So, if you take that $50 million worth of potential sale assets out, we're talking about a market cap of $25 million against potential earnings in 2022. And again, there are some risks to 2022 because it's a little while away. And 2021 might still be ugly because they're still dealing with what they're dealing with. But it's looking quite cheap.
Yeah, it is. So talk me through their balance sheet there. We spoke about it getting cleaned up in April. What's their balance sheet look like?
Well, I've got net cash of somewhere in the vicinity of about $20 million. They have access to facilities, obviously, to fund working capital for projects. But I believe they paid, if not all of that debt down, I believe they paid the vast majority of the debt down. I'm afraid I don't have the numbers right in front of me at the moment. Yeah. But I did note that interest coverage in 2023 is, I believe, in the teens. So they're well and truly covered in terms of financing their debt. I suppose that happens when you go and raise essentially a market cap to reset yourselves. And again, from a balance sheet perspective, it was absolutely a reset in April, May. In terms of the actual operations of the business, I know you want to call it a turnaround, but the truth of the matter is, at least in my mind, the business itself is still sound. They veered off track for sure. There were some poor management decisions that led to some poor outcomes, but we're not chucking a Yui on a 4-lane highway. We're sort of, we're making a veer to the right back onto track. That's the way I like to think.
I didn't mean turnaround as a derogatory term, Michael. No.
Well, we can talk about turnarounds too if you like, but
no, talk to me about Talk to me about their margins then. You've mentioned that a couple of times about that being a key focus. What sort of margins, call it maybe in 18 months' time when the projects are well and truly operating at full capacity, what sort of margins can a business like Decmil expect, do you think?
Look, it's obviously a contracting business, so margins aren't going to be wonderful relative to other sorts of businesses. But I believe without them explicitly stating what their margin goals are, my understanding is they're looking at having margins that are around about the high single digit level. So, 8 to 9%. So, on that basis, assuming some 40 odd million dollars worth of overheads, we think they're probably going to make about 600 odd million dollars worth of business in 2022. And we think that might go as high as 750. I've seen some broker notes suggesting even higher in 2023. So that's the basis on which, I'm calling out the 20 odd million dollars worth of cash earnings in 2022 and the 30 to 35 million odd in 2033. So, certainly there are some risks. Got the broader market risks. The market's looking expensive. It's getting a little bit scary, but I suppose for us it's been scary since 2017. And had we exited then, our investors would have missed out on some wonderful opportunities, as would have we. So, when it comes to the macro stuff, you've got to keep it in mind, but it can't be the driver of the decision making. I think we've spoken about the risk of inflation in the future as well. Again, at some point it's probably going to be a problem, but what proportion of your time and mental energy should be dictated to trying to work out the implications. I think it becomes a bit of a moving target and a bit more effort than the value you're likely to get out of even coming up with a legitimate answer or outcome.
And so when you're looking at a company with a new CEO, we won't label it a turnaround story, Michael, but a newish CEO.
Look, I'm not offended. It's not my company. I'm just an investor. But I tell you what, Dickie will take offense.
Well, Dickie's doing a good job from all reports. How would you view, when you're looking through your investment process, how do you analyse a company with a new CEO that is making some changes versus a company with a management team of a 5 to 6 year track record? Do you view it differently, or is your investment process the same for both companies?
Look, I think it's horses for courses. I was reading a book recently on some of Warren Buffett's better investments, and one of the running themes seems to be a temporary change in circumstance, or a change in management, but the management team put in the right sort of processes and whatnot. I think it's worth noting, certainly with Decmil, it's not like Dickie and Peter, who are the two fellows who we've had conversations with and we've met. It's not like they were coming out of left field. These are two guys who have worked for Decmil on and off for years. These are people who've got 25 years plus of experience in the industry. I reached out to Dickie and I said, look, I'm possibly going to have a chat with Chris about your company, and I've got a sense of what your experiences are and what you've done, and I'm very comfortable with it. But can you send me something of a CV just so I can get a better sense of your industry experience? And he sent me a CV, and it was 3-page of fine print, deal after deal after deal of construction and engineering. And, he's been doing this for 25 years. There were some 75 projects that he was intimately involved in. So it's not like these guys are coming with no background in the industry or no background in the company, because both Dickie and Peter have experience with Decmil and extensive experience in the industry. And it's not like they're looking to initiate some sort of new process that has never been heard of before and is revolutionary. All they're doing is saying, we've got this, we've got this company. It's a wonderful company that, the foundations of this business are great, but we as a company have lost our way over the last couple of years. Let's just set it back on track. So that's a much simpler process to get comfortable with than, say, a company looking to radically change what the business is doing. So again, Decmil, if we were looking at a company that was radically changing everything it was going to do, we probably wouldn't have looked at it. It's most turnarounds don't turn around. That's the problem. So I said to Vas the other day when we were talking about turnarounds, he said, I said to him, look, we don't actually invest in turnarounds. He said, what do you mean? I said, we invest in turned around. So we're looking for evidence that we can uncover that whatever this management team are doing, it's actually already working. And the market might not get it. The market might not understand it. The market might not see it yet in the earnings profile, but we're not looking to take a risk on some managerial team's hopes and dreams. Rob, our distribution guy, he often says, hope is not a strategy. We're not looking to invest in hopes and dreams. We're looking to invest in stuff that we can touch and feel and stuff that we can measure. And I think with Dickie and Peter and the team they've brought on, these are all guys with exceptional experience. And perhaps even more than that, their communication has been fantastic. Yeah, not just when there's something good to say, but even when there's something bad to say. The good, the bad, and the ugly. They've been very, very proactive in communicating with the market, and they've made themselves available to us to have chats just to get some clarity if we're unsure around, what the meaning might be of one of their announcements. So I'm thrilled that we're invested with a management team that take that view to communication, because not all managers do that. And I'm also thrilled that they've got this red flags process they've put in place. Processes might not be the most exciting things, and it might take some of the magic out of the end results. But if you've got a process in place, it's replicable. You can do it again and again and again. And all of a sudden you go from not really knowing what's coming down the pipeline to being able to really have a good sense of what earnings are going to look like, and what projects are going to look like, and what the risks are going to look like. So again, we've sort of gotten off track a little bit. But if you're asking me what I think of Peter and Dickie, so far so good. Obviously, time will be the ultimate judge of whether we're right or wrong. But certainly everything we've seen from them so far has been very, very promising.
I like seeing you fired up, Michael. It's a great story. Really appreciate it. I think it's a very interesting one to follow. So thanks again, mate. Appreciate the time.
No worries.
Thanks, mate.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.